What position size is right for me? This is the question we're going to answer in this video. Before I talk about position sizing, I want to mention that this video has a prerequisite video because position sizing is sort of blended with risk management in trading. So before you watch this video, please go ahead and take a look at my risk management course, which I put its link here, and then come back and resume this video. Okay, I think position sizing is a topic that does not get the attention and credit it deserves. If you have a look at the view numbers on videos about position sizing on YouTube, you can see that they are much lower than the ones with the title, for example, I did this and made $1 million in just 2 days. In this video, we're going to examine position sizing not only from a technical standpoint, but also from a psychological perspective. Then, based on our findings, I'll show you a really cool technique to calculate your position size that not only helps your mind from overloading, but also helps you to grow your account at a reasonable and steady pace. Let's say you have a $5,000 account and you've been using a trading strategy for a couple of months on it. Let's also assume that your profit growth is something like this. Some dips here and there, but overall, your P&L has been positive for the period. Let's also assume that you've been just trading gold with this strategy and you kept a 0.5% risk with a fixed stop loss of 100 pips. This means that you've only traded with 0.05 lot position sizes. One day you say to yourself, man, I'm really good at this. I need to load up my profits. And suddenly you're opening 0.1 lot position sizes instead of 0.05. Here comes a big problem with this decision. And that is when you lose or win, you lose or win bigger, which causes more intense emotions compared to your previous trades. And if you claim that you don't experience harsher emotions when you trade with bigger lot sizes, you're simply lying to yourself. To get to the bottom of this, let's get a little nerdy, shall we? In 2010, the Open University Business School did a research by the title The Influence of Emotions on the Decision-Making and Performance of Traders. There are key takeaways in this research that could help us make the right decision when adjusting our position sizing and risk management. They examine the impact of traders' emotions on their perceptions, behavior, and performance in financial markets using interview data from 118 professional traders and 10 senior managers in investment banks located in London. Their goal was to shed light on the ways in which traders experience and regulate work-related emotions, and how these processes change with the increased expertise. Based on previous studies, they already knew that intense negative emotions enhance the valuation of short-term outcomes regardless of negative long-term consequences. In simpler words, when your losing trades become greater, negative emotions kick in, and you might take less rational and more risky decisions to immediately cover your losses and totally forget about the future's regret moments. To deal with these negative emotions, they introduced emotion regulation to mitigate the impacts of negative emotions on traders' performance. One approach to managing emotions is to select, avoid, or modify situations. It can be as simple as walking away from your system for a while or drinking cold water. After analyzing the interviews, they found out that for the less experienced traders, trading is marked by significant and persistent emotional responses to success and setbacks. When asked directly about emotions, traders in low experience group typically started by presenting themselves as fairly immune to the impact of emotions on their trading. However, as the interview progressed, they would often reveal rather more vulnerability to emotions than they had claimed initially. I'm a bit of a cold fish. I don't think emotions greatly affect my decision making. If you're making money, you're achieving your objective. But later, When you lose money, it can be horrendous, violent mood swings. You don't know what to do when you lose money. This was from a low experienced, low paid trader. Senior traders and trader managers, though, frequently talked about the way in which they had developed a capacity to regulate their own emotions and trade more evenly regardless of success and setbacks. Traders in the experienced group more commonly talked about strategies for emotion regulation. For example, this is a quote from a high experienced, high paid trader. Big losses and big gains can swap around fairly quickly. And once you understand that, then you stop concentrating on the loss and you start concentrating more on how to make money back. One big trade is not going to make anyone, and one big loss doesn't destroy you. So, from this article, we can conclude that your emotions can swing, no matter if you are a high experience or low experience trader. The difference lies in your approach to regulate emotions. The methods discussed in this research were designed to cope with emotions after they arrive. But what can we do to reduce our mood swings during trading? We want to get as least unemotional as possible. Let's get back to the example that I mentioned earlier, your $5,000 account size. The very first measure you want to take is to stop increasing your position size when your account size has not yet increased proportionally. This means that you should have a step-by-step increment in your position size, which is obviously relative to your account size growth. Let me show you the technique I use for my position sizing. As you see, we have two curves here. The red one is the account increase in terms of account growth. It's obvious that they are equal, hence I define its formula as y equals x. The blue one is the position size increase in terms of the account growth. The best curve to choose for that is y equals 1.0 times x to the power of 2, because it's simple to calculate and also guarantees a steady and safe account growth. For example, if the account reaches a 10% profit, I'm only allowed to increase my position size by 1%. The profit becomes 20%, and I'm only allowed to increase my position size by 4%. And as we can see, my pace in incrementing my position size increases as my account becomes bigger. And once I reach 100% profit, I can finally double my position size. Now, what if my profit is something between, let's say, 55%, yes? Then I simply stick to the lower bracket value, which is 25% in increasing my position size. So we kinda take this staircase increase here. Don't worry, you don't need to calculate these numbers every time, because I summarize them in a table like this. According to this table, you have 10 levels or stairs in adjusting your position size based on your account growth. Once you reach the 100% level, you reset the whole table and start your position size calculation from level 1 again. For example, for your $5,000 account, it means as soon as you make it $10,000 or 100% profit, you double down your position size and start this table from the first stair. But this time, you're gonna assume that your initial balance is $10,000 instead of 5 grand. I promise you, if you follow this table every time you trade, you will experience no flood of emotions in your trading plans, and you gradually see substantial gains on your trading account as well. That's it for this video, guys. Thanks for watching, and I'll see you in the next one.